Good to have you in here this morning. It is a hot one, and it's going to get hotter apparently. Um, I've been told London's going to be 32 degrees. Sounds fun, yeah. Um, we complain when it's hot, complain when it's cold, complain when it's wet, complain when it's dry. Markets, yeah. More angst if we have a quick look at the S&P 500. It recovered Friday, and it's up so far this morning. NASDAQ, NAS 100. Yeah, look at that. So all I could sum it up by saying that the tech stocks continued last week to suffer heavy losses. And it's this pressure from what's called the rotation. It was described as the violent rotation a couple of weeks ago. It's now the big rotation out of these big mega cap stocks, the tech stocks that we've talked about, the Magnificent Seven, likes of Nvidia, Microsoft, Amazon, Apple, Meta. What else have I missed? Alphabet, yeah. Anyway, and the rotation is into the much unloved smaller cap stocks, who have been the main beneficiary with the recent fall in inflation, which basically implies a near certain first interest rate cut from the Federal Reserve. Not this week, there is a meeting this week, but the first rate cut is expected at the 18th of September meeting, the one I've just clicked on there. Anyway, low interest rates benefit, as we mentioned last week, it benefits small caps because they typically have high levels of debt to fund their growth, fund their expansion, whilst the mega cap stocks, the Magnificent Seven, earn vast amounts of interest on their surplus cash. Apple apparently has got something like $200 billion of surplus cash, which is absolutely huge. Anyway, interest rates, if interest rates go down 0.75%, i.e. 3/4 point cuts by year end, that's quite a big chunk of those earnings, those interest rates, that interest that they're earning on the money, that's gone. Yeah. Anyway, last week, just for the numbers, the NASDAQ fell 2.54% to be precise. The S&P 500, which has got a lot of the stocks in it, because this is the Standard & Poor's 500 by market cap, so it contains all of the top stocks by market cap, so the top 500 stocks in the US, and then the Dow Jones, which is a curious index. The Dow Jones, the components are chosen by a committee, and it's actually represents industrial and commercial businesses in the US, and it's 30 stocks. It's called the industrial average. That actually closed up 267 points last week. Not anything like as bad as the S&P and the NASDAQ, obviously, which was significantly down. But you only need one or two stocks, especially in these earnings season, to outperform, and it can have a significant impact on the index. Is it a good reference of corporate America? It's not really. It's not. So the bizarre thing is, whenever, the 9 o'clock news, the 10 o'clock news, or whatever news you might watch, they always say, oh, the US has been a big move, the Dow fell or rallied. But actually, that's not what many people follow. Not if you're in the market, not if you're a fund manager. The S&P 500 is your reference. Anyway, as I said, the sell-off in tech stocks gathered apace last week. The NASDAQ and S&P actually suffered their worst days. I think their NASDAQ suffered its worst day last Wednesday. When was it? Yeah, so that's its worst day last Wednesday. That's its worst day since October 2022. And the S&P 500, it suffered its worst day last Wednesday since December 2022. So you can see there's a lot going on. Yeah. We talked about Tesla had its results last week. The EV maker fell 12.3% last Wednesday, and that followed a pretty poor set of quarterly results released the evening before. with profits lower than forecast. Alphabet, the one that owns Google, also last Wednesday fell quite sharply, I think 5%, and actually it beat analysts' forecast. Weird, and yet it fell. And that was down to guidance, which took the shine off the numbers. Nvidia, I've actually got the chart of Nvidia here. Look at that. So we're talking about a fall from 135 on the July the 11th, and we hit a low on Friday of 106.14. That's a huge, huge fall. Anyone trade Nvidia? Has anyone got any Nvidia shares? You probably have in your SIP or some funds that you invest in, but it's pretty interesting. It was always going to happen. Was I brave enough to call it up? Of course not. There's just no way I was going to know. But actually, it was the inflation reading from a couple of weeks ago, 2.5 weeks ago, that tipped this market over. Anyway, economic data, ironically, continues to support a first rate cut, but it had been pretty good, and it was good last week. So whilst it was good, the Federal Reserve, the FOMC, the committee that sets rates, is still likely to cut rates. So we're likely to see that first rate cut in September, as I say. But when we look at the data last week, it wasn't bad at all. If we go to last week's data, we had services PMI data, which supports the view of a growing economy, whilst the first reading of GDP, this is the GDP, advanced GDP, and you might think, Chad, that's really strong. Wouldn't that stop the Federal Reserve raising rates? Remember, the second quarter ended at the end of June. We're approaching August now. It's old news. It really is old news. And there's other data that the market is more fixed on. But what was interesting was that the price index really supports the PCE data, and you can see that there's less inflationary pressure pushing the GDP up, so 2.3% expected at 2.6%. So that's good news. It points to a growing economy, moderating inflation, sometimes referred to as a Goldilocks economy, not too hot, not too cold. And that'll give the Federal Reserve room to cut rates, as I say, at the September 18th meeting. And I think the odds of a cut are absolutely, probably, no, they couldn't be more certain when you look at September. Well, there's the current rate's 5.25 to 5.5. There's no chance of it staying at 5.25 to 5.5. There's an 87.7% chance that it's going to be cut by a quarter, and nearly a 12% chance that it could be cut by a half, and some weird possibility of a 3/4 point cut, which is barking. Anyway, so that's what it is, and this changes constantly. So as data releases come out, and we got some important stuff this week, that'll have a real big effect on the markets and on the expectation of rate cuts. Europe too had a few wobbles last week. We have a look at DAX, all over the place. Yeah, it's got a lot of tech stocks. Yeah. Tech stocks, ARM Holdings, I know it's listed in the US and at NASDAQ, but it also fell significantly. It's obviously a UK stock, tech stock, 5.4%. It fell last Wednesday. The Euro 600, sorry, the stocks Europe 600, that's a technology index, fell 2.7% last week. And that's reflected in the wobbles that you saw, because there's quite a few tech stocks in the JER 40, the DAX 40. Yeah. UK markets, yeah, we had about a week last week. Big jump Friday ahead of the MPC interest rate decision this week. I think expectations have risen over the past few days, with the decision, I think, very much in the balance now, with the Monetary Policy Committee weighing up the progress on inflation, and it is at 2%, the headline, against stronger than expected growth in May in the service sector, and that's the problem. The service sector inflation is the thing that is causing the Bank of England to have doubts. And it was interesting that the Bank of England's chief economist, a chap called Hugh Pill, who'd actually been supportive of a rate cut, described the service sector inflation as showing uncomfortable strength. And it's just stuff like that that makes you wonder: is there going to be a rate cut? Anyway, the Bank of England cut rate. Sorry, the Bank of Canada cut rates last week. The European Central Bank cut them the previous month, if you remember. The Federal Reserve is likely to be cutting rates in September, which means if the Bank of England don't cut this week, they could be one of the last major central banks to start cutting rates. But you can't have the economy growing more than expected. You remember the monthly GDP data that we saw, was it last week or the week before, plus 0.4%. It was double what was expected. You can't have a strong economy and have rates being cut. Rates are normally there to moderate price pressures. When you've got a stronger economy, you've got normally price pressures increase. Anyway, it's a balancing act. And of talking of balancing act, the Japanese central bank, the Bank of Japan, have got to do the same thing as well. Look at the Japanese yen, absolutely tumbling. Anyone trading yen pairs successfully? This has been a big move. This is something that's driven by the carry trade. Does anyone know what a carry trade is? Anyone know what a carry trade is? Anyone like to know what a carry trade is? Come on, let me know. Okay, one of you. A carry trade. So a carry trade basically is, carry. Yeah. So it's trading interest rate differentials, says Christopher. Yeah, it is. Basically what it is, and it's been used by managers, hedge funds, etc., to take advantage of a country where interest rates are particularly low. And it's often been the Japanese yen. I remember doing it in the 80s. When interest rates go down really low, you borrow in yen, where the cost of borrowing is negligible, swap the Japanese yen to dollars and invest it in Nvidia. Isn't it fantastic? What can go wrong? Rajiv, I was trading the Japanese yen but lost, so it's very difficult to predict the move. Well, yeah, when we say predict the move, I mean, at the moment, the strength in the yen is the reason why the Japanese stock market, the JPN 225, is weak. Yeah, I understand that. Yeah, but Christopher, you're quite right. Interest rate differentials. It's the carry trade. The problem with the carry trade is that when the Japanese yen started to rally, the hedging cost. So if you think about it, let's say the yen's at 153.60 where it is at the moment. If we borrow yen at that rate at 0.1% and invest it in something, say US treasuries that are yielding sort of 4.5%, we're going to make a ton of money. What can go wrong, Jerry? You might as well just keep borrowing yen until we're blue in the face. What happens when you need to swap those dollars back into the Japanese yen, and the Japanese yen has increased in value significantly? You'll suddenly make a significant loss. You won't have enough dollars to repay the yen. And so what you have to do is to hedge or run a book hedging your Japanese yen. And this is where the cost of hedging your carry trade has got too much. And this is all of those carry trade investors are rushing for the exit. They benefited by the ultra low borrowing costs, but they've swapped them into dollars, and suddenly they're seeing those dollars lose significant value against the yen. Well, certainly since whenever it was started on the 11th of July. Yeah. Anyway, we've got the Bank of Japan also meeting this week, and other central banks setting interest rate policies, and what they're going to do also remains uncertain, a bit like the Bank of England. Traders just not sure whether the Bank of Japan will raise rates again and cut the amount of Japanese government bonds that they've been buying. Anyway, despite the weaker than expected inflation reading recently, the Bank of Japan is under real pressure to raise interest rates to bolster the yen. So you can imagine what might happen is if they don't, this yen, it could fly. It could fly all the way back up to 160. It's difficult. You've just got to be, I would be very careful about having many positions on ahead of the Bank of Japan. We'll go through the calendar in a second though, don't worry. Listen, on to commodities. Oil, I think, the data out of China and Europe points to weaker growth, weaker oil demand, especially from China, which is the world's largest oil importer. Oil obviously is reacting to that, to the general weaker economic data, and sustained further falls last week. Brent crude, what was it, down 2.5% last week, hitting 7-week lows. So yeah, you got to go back to 10th of June. Gold, well, gold's an interesting one. Gold should benefit from the prospect of lower interest rates in the States because gold is priced in dollars and there's an opportunity cost to holding gold. Gold does not pay you a dividend. Gold does not give you any benefit apart from the fact that someone might buy it off you for a higher price than you bought it. You have to insure it. You have to put it in a warehouse or a bank vault somewhere. It's an expensive thing to hold, and there's an opportunity cost. You could just leave your money in the bank, invest it in government bonds, US treasuries. So if interest rates come down, the opportunity cost comes down to holding gold, which makes gold more attractive. The problem with interest rate expectations, with lower interest rates in the US, if the dollar weakens, that's good news. But unfortunately, the dollar has sort of been strengthening over the last week or so, and that's sort of also stopping gold rally, if you know what I mean. Anyway, there we go. Let's get on to what's coming out this week. It is a very, very, very busy end to the month, start of the new month. It couldn't be more busy in terms of important announcements. We've got two of the most important releases in the US coinciding in the same week. So that's the FOMC interest rate decision and non-farm employment change from the United States. Why are they important? Both of them affect directly the Federal Reserve, the FOMC that sets interest rates. So we, or the market, needs to know what that data is, and they will react accordingly. In the UK, we got the Bank of England's MPC meeting, and this keenly awaited decision on interest rates, which I think hangs in the balance. It was looking like it wasn't going to happen, but expectations have sort of jumped a little bit. And then in Japan, we know the Bank of Japan are meeting and they need to demonstrate that they're willing to support the yen and raise rates, yeah, despite lower inflation. So let's kick off. Nothing on Monday. Yep, no key scheduled data releases on Monday. In a very busy week. It's all crammed into 4 days. Yeah. China on what am I doing? Not China. We have got why have I jumped? Yeah, I jumped to manufacturing and non-manufacturing or service PMI data. I'm not really going to focus on Aussie data and the consumer confidence. Actually, we could look at the consumer confidence. That's a good point. The Conference Board consumer confidence is the only release on Tuesday I'd be looking at, dipping to 99.8 from 104. I do like this sort of data that tells me, gives me an idea about what's going to happen in the future. These are called leading indicators as opposed to lagging indicators, which are the GDP numbers that we've talked about. Those, the ones that was released last week that showed the US economy grew 2.8%. That's the first reading. That's telling us what it did between April, May and June. We want to know what it's going to do in August, September, October. That's it. And that's why consumer confidence is important to us. Anyway, we're expecting a slight softening in sentiment there. We go to Wednesday, which is what I had jumped to initially. Chinese data, manufacturing and services PMI data, slightly weaker on both measures, but that'll affect oil. Yeah, that'll affect other assets if it's really out of kilter. But the Chinese economy is definitely struggling. They're focusing on the tech sector. They've cut interest rates, yeah, which was a surprise. Is that good for the markets? Well, it's a little bit of a worry that they're having to cut interest rates when perhaps the market generally felt that there was no need. Anyway, that's China. We then have early in the morning, also on Wednesday, the Bank of Japan, or BOJ, uh, policy meeting, monetary policy meeting, to tell us what they're going to do with interest rates and their policy statement. We're expecting a minor increase in rates, although looks like Forex Factory haven't put anything in there. But I think on balance that they will raise rates by a very modest amount, 0.1%. And I think it does remain quite finely balanced, but I think the Japanese yen will be extremely sensitive to this release. So please, please be very careful what positions you go home with on Tuesday night. And if you are doing any day trading in any yen pairs, please be very, very careful. Yeah. So the yen will be extremely sensitive. If they don't make any move on rates, that Japanese yen could be hurtling back up to 157, up to 160 in short order. So it'll be very, very volatile. So just please take care with the Bank of Japan. After the Bank of Japan, we've got some inflation readings from the Eurozone. So this is the first reading of core and headline inflation. The core CPI flash estimates is expected at 2.8%, just hovering over it now. Last at 2.9%. The headline is expected at 2.4%, last at 2.5%. Just to remind some of those of you who are new to this, the core reading is the one, it excludes the volatile components that caused inflation to rise in the first place. Food and energy, once they're taken away, that's the ones that are very spiky and have come off quite sharply. You're left with the core, which is the real underlying inflation rate, and that's the one that central banks are really interested in. So, and the good news is for the European Central Bank, yeah, if it does come to pass and inflation continues to moderate, they will be happy, and the market will likely price in another interest rate cut, which is expected from the European Central Bank in September. And then we have this ADP non-farm employment change. So you'll know about non-farm employment change. It's a strange description. It's because they being the statisticians in the US, they don't include farm employment because it's so seasonal and it tends to really disrupt the data and clouds the picture. So they remove the farming sector from it. So it's called non-farm employment change. ADP is a private payroll company that does the payroll for lots and lots of companies. So it has its own take on the number of new jobs. More volatile than the Bureau of Labor Statistics on Friday, but it's 166,000 new jobs are created. That's what they're saying in June. We then jump to the main event, certainly from the US markets, but we've got one here in the UK as well. This is the Federal Open Market Committee. That's the rate setting committee at the Federal Reserve, the US central bank. And as you can see, they are not going to change rates. And I think anything but an unchanged announcement would be a major surprise. We've already looked at the CME FedWatch tool, and it's an absolute shoo-in that nothing is going to happen this month, and an absolute shoo-in that on the 18th of September they're going to cut rates. Anyway, there's going to be a press conference. There's a statement, the FOMC statement that will be poured through. The press conference is half an hour after the announcement. But the US dollar, US assets, global assets, European, UK assets, they'll be sensitive to this announcement because what happens in the US really affects global markets. Always. On to Thursday morning. The Monetary Policy Committee, that's our own rate setting committee here at the Bank of England. And yeah, it's going to be close. It really is. With mixed expectations, I think a quarter point cut would signal the start of the of a more accommodating monetary policy. I'm not saying that they are going to do that. I think on balance, it certainly Forex Factory of having are expecting a quarter point rate cut, but it's definitely not clear cut, and it definitely wasn't clear cut a couple of weeks ago. Anyway, sterling and UK assets, that's UK gilts, our own sovereign debt, and all equity markets will be very sensitive to this, especially the FTSE 250. So yeah, be warned. And then in the afternoon, we've got ISM manufacturing. This is another reading from the US manufacturing sector. And there are signs that the manufacturing sector in the US continues to improve, getting very, very close to the all-important 50 level, which denotes expansion over contraction. I'm not sure. It has been above it. Okay, it's changed again. Okay. No, it's this one. I clicked on the wrong one. That really did confuse me. I was thinking it is above 50. So this is the one. This is hasn't been above 50, and it's getting very, very close. The ISM manufacturing PMI data is the one that everyone watches. That's the one that's on everyone's radar. When it's above 50, it means the actual sector is expanding, not contracting. And as you can see, it's been in the doldrums ever since inflation took off. Yeah. Right, on to the second most important data release this week, which is the non-farm employment change. This big one that I've referred to a couple of times already. 177,000 new jobs expected, less than the 206,000 jobs last month. In May. This is the in June. Sorry, this is the reading for July. Bear in mind, you do get revisions, and sometimes when they publish the data, you can get a big revision in previous data. I doubt there'll be much of a revision. This wasn't exactly a big outlier reading, to be honest. 4.1% unemployment rate, same as the previous month. I don't think this data is going to have the usual impact it has, really, because it's coming just 2 days after the Fed statement on Wednesday evening. I guess it could alter the prospects of rate cuts. Certainly projections for rate cuts for November and December if the data is really way off consensus, but certainly dollar and dollar assets will be sensitive to this, and possibly global assets if there's a big shift in the US, but I'm not expecting it. That's sort of it. Oh no, we've got quarterly earnings. Yeah, we've looked at Nvidia. There are other tech stocks, so everything is about what the NASDAQ's been doing. So the sell-off, this big rotation, we need to talk about that. The tech earnings, we're in the middle of Q2 earnings. Microsoft, Meta, and Amazon, there's a ton of stocks that are releasing this week. But if you want to know the real key ones, Microsoft on Tuesday, Meta, which is Facebook, on Wednesday, and Amazon, the huge supermarket in the cloud that we all get sucked into using because it's cheaper than going to the shops. They release on Thursday. So some big tech stocks out again. Is it going to undermine the NASDAQ and the S&P further? Well, we'll wait and see. But a really important week for the markets this week, everyone. So please, we'll be distributing some notes later on. Hopefully we'll get to see them. But it's something you should just make sure you've got all those key events written down. Set an alarm. I know people who set alarms for datas. Sometimes you get wrapped up in trades and you suddenly realize, oh my God, I forgot about that. You know, the Bank of England at midday, I forgot about the FMC at 7 o'clock, etc., etc. So yeah, whatever you need to do, keep yourself reminded. That's it. You've been incredibly quiet. Maybe you're incredibly hot. I'm not sure. Maybe I'm just covering all the bases. But anyway, listen, thank you very much. We had a few questions. No problem, Gary. I hope it is. Any questions, just direct them at me. I love answering questions, but I do know how to make sure I cover most of the bases anyway. So I'm not necessarily that miffed that there aren't many. But listen, thanks very much for attending. And what's the date next week? It's the yeah, 5th of August. Yeah, so new month on Thursday. Bit of window dressing on Wednesday evening, maybe. Yeah, who knows? No problem, Edward. Rajiv, thanks. Have a great one. Can you please advise on currency strength, how to check and which website we can look into? Uh, Currency strength. Well, research is a difficult one, Rajiv, because the problem with research, I mean, I subscribe to the FT, so uh, and in the market section, you've then got currencies, but it's just generally long-term stuff. I mean, there are articles about the Trump trade and how Trump wants to weaken the dollar, but it's only longer term. Yeah, it's also recorded, Stefan. This webinar is recorded. That's right. It's available sort of, I think, a couple of hours afterwards. Um, yeah. Free websites like Thomson Reuters I use. They're quite good. Get it for free. The other one, oh no, that's the wrong. Clicked on the wrong one. Thomson Reuters News. I wanted. Perhaps that's what I should have put in. Yeah, that's it. So they've got a great one on markets. I think you get a few. I think you have to actually register to have access to it all. And then obviously our own BBC, they've got a great business section. So we click on news and go to business, gives you all the business news, etc. And it's pretty good, nice and simple. It's not so that in depth. Yeah. Okay. Yep. Thanks very much. It's coming up to 20 past. It's always my cut-off time. We will reconvene again at 8 a.m. next Monday. In the meantime, good luck with the week. Don't get too hot. Draw curtains and shut windows, I've been told. Keeps the heat out of bedrooms and the top end of the house. Anyway, listen, don't overheat, and we will again catch you all again in a week's time. Thanks for listening. Bye for now.